Hey there, everyone. Happy Monday and welcome to the Final Bar. It's Monday, May 13th, 2024. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a cloudy but beautiful Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. Had a fun experience last week at the Money Show. Thanks for hanging with us as we did a couple shows from the hotel room there last week. Had a really good time meeting some of the viewers, some of you, and talking with some of the other speakers as well. Interesting times as we discussed at the event last week as we continue to monitor going forward. A choppy, sort of noisy day for the S&P 500, netting out to not much change, but the NASDAQ actually pushing slightly higher. Technology back at the top of the leaderboard, edging out real estate and utilities. So still some defense at the top. A little later in today's show, we're going to do a segment called It's All Relative, where we focus on the relative strength characteristics we think you should be most aware of. We're going to focus on utilities and technology, two sectors which have been some of the stronger sectors on a relative basis year to date, what those prospects may look like going forward. With that in mind, let's get to our market recap and break down today's price action. Before we look at a chart, though, I do want to answer a poll question we had going just over the last 24 hours or so. Where will Bitcoin be on May 31st, 2024? You got between now and the end of the month. Where does Bitcoin end up? 22% of you saying over 70,000. We'll say 44% of you saying below 50,000, which means the most common answer, 34% of you said between 60 and 70K. Let's actually look at a chart of Bitcoin and see how things are actually playing out. You know, it's interesting coming in on Monday because Bitcoin, as you and other cryptocurrencies, as you know, trade 24 hours and they trade over the weekend. And so there's a decent amount of volume happening on some of those times. I haven't really looked at Bitcoin volume figures in too much detail, but kind of here's where we're at, right around 63,000. So about 34% of you saying we remain within this framework, right, between 60,000, which is essentially the support we've established over the last couple months, although we did briefly dip below there at the beginning of May. Overall, 60K has been a pretty consistent floor, and just over the last couple days, you can see once again we've tested that level of support and found and bounced off of there for now. As a reminder, that came from a couple different things. It's a big round number, 60,000, which is often pretty important for Bitcoin, but also it's that first Fibonacci support level. So I would argue a bounce like this still sort of finding support at a predictable level. The question is, do we mount any significant gains? And before we could get above 70,000 and make 22% of you pretty happy, we first have to get above the 50-day moving average. That's where Bitcoin has stalled out in mid-April, again in early May. So keep an eye on that one. We'd love to see the momentum improve on Bitcoin as well. Thanks so much for answering that poll question, by the way. Don't forget to follow us on all your socials so you don't miss the next poll question. Getting to the market averages today, you can see a bit of a mixed bag, but overall, the growthy stuff doing better than the value stuff, generally speaking. And I can say that by the fact that the NASDAQ composite was up 0.33%. The Dow was down 0.2%. Way more growth heavy in the NASDAQ, way more value heavy in the Dow. So that's my generalization of what's happening. Let's get a little more into the weeds. The S&P, of course, in the middle. No real change from Friday's close, although we chopped around a little bit. The S&P finishing right around 52.21. So 52.50 is your all-time high. We teased that level back on Friday. We teased it again here Monday at the open, but still not mounting gains above previous all-time highs. Mid caps were flat for the day, small caps slightly higher. Again, no real change in the major averages, basically all around. The VIX did pop a little bit higher, though, which is an interesting one. You had choppiness, no real directional move. The S&P was more sideways than anything, but the VIX actually moved up a full point, finished the day around 13.6. So 15 is that basic back of the envelope sort of level that I look for. VIX below 15 is a low volatility, fairly orderly, fairly constructive bullish configuration. VIX above 15, while not necessarily the end of the world, tells you there's elevated uncertainty, maybe elevated fear. So a VIX over 15, given the fact that the S&P is not too far off of all-time highs, I'm looking for any signs that things are not great, any signs that would tell me maybe this is a top, maybe this is a peak. And so you look for warning signs. VIX over 15 is not one we've seen yet here after coming below that threshold, but that's what I would be looking for right about now. Looking at the interest rate environment here, we're looking at the yield curve. You can see that the 5, 10, and 30-year points, that is, all move slightly lower, but not a huge move. The 5-year and the 10-year points are right around 4.5%. The long bonds are around 4.62. 2, we'll call it, and the short end of the curve, of course, still elevated. This is where the Fed is, more manipulating interest rates on the short end. The long end is more through Treasury auctions, but then really more the free market mechanism that sort of settles those things in. The 10-year point is usually the most widely used and most important benchmark across the curve. So rates continue to come down a little bit, not a ton today, but continuing to come off. And as you think about sectors like technology doing well, rates coming down is usually a good sign for those sectors. But it's not all a perfect mapping. I'm seeing some interesting confusions here right now. The bond market's using the TLT. So this is looking at bond prices about 0.25% higher. And the dollar index, no real change from Friday's close. Gold prices moved lower today. The GLD was actually down over 1%, and that's a bit of a contrary move to what we've seen up until Friday. Friday was actually a pretty good up day for gold stocks. You're seeing a bit of a retracement there today, but not by much, down about 1%. Silver slightly higher. Copper, natural gas, crude oil prices all firmly in the green. Cryptocurrencies overall stronger rather than weaker. As we looked in the previous chart, Bitcoin now just over 63,000. Ether now back below 2950, back below 3,000 to 2950. We'll call it 2951. Mixed results for the rest of those top 10 coins that we track on our platform. Looking at the 11 S&P sectors here, you can see utilities and real estate, which last week I feel like most days one or both of those sectors was at the top of the leaderboard. Today, technology, a sector you would normally more expect to be at the top of the leaderboard, actually doing quite well today. The XLK was up about 0.5%. REITs were number 2, up 0.25%. Utilities, materials, healthcare, honestly about flat for the day. On the downside, you can see the worst performing sector, industrials, was really down less than 0.5%. So industrials, financials, consumer staples are at the bottom. So honestly, no real significant movements this trading day in terms of directional moves in the broad sectors and the broad indexes. Plenty of movements underneath the hood, and we're going to go to some individual stocks as we get to the rest of the market recap. Did want to highlight just in terms of the Magnificent Seven, air quotes around that, of course, these leading growth names. Tesla finally having a pretty decent day, up 2%. Apple, the chart of Apple is actually looking less bad by the day. It's funny that some of the previous the leadership names like a Meta, which it's pushing to all-time highs, actually coming off about 1.7%. Apple and Tesla, two of probably the worst performing FANG stocks, actually at the top of the leaderboard, both up about 1.5% to 2% through the day today. Let's look at a daily chart of the S&P and just see how things have played out. We'll talk about breadth here briefly because the breadth conditions are pretty strong. I took off that bear flag pattern because it was just looking less and less like a classic bear flag. And I think lines like that, I don't want to get married to that particular analysis. Overall, we're trending nicely off of the low in mid-April. So for now, the markets are in a position of strength. Now we have the seasonal headwinds to think about. I'll mention in a short while here as a reminder, I have a webcast coming up tomorrow on Tuesday at 1 p.m. Eastern. We'll talk about that sell in May phenomenon and debate and discuss whether that could be a winning strategy in 2024 or not. But seasonality aside, just look at the price action. You can see that in April, May of this year, very similar to August, September of this year, where you made a new high, we broke below the 50-day moving average, we undercut a previous swing low, we made a low and then popped back briefly above the 50-day. And here's where things may be differentiated a little bit. Back here in September, this is around Labor Day of last year, we made a clear lower high. We quickly went back below the 50-day moving average. The RSI never got above 60, and those were all signs that this was confirming the fact that this uptrend phase off the March low was now exhausted. We're now making a lower high. We're now in a downtrend that ended up continuing another month or two. Here, we can see everything lines up until kind of this moment. We are still, for now, at a lower high, but the RSI is drifting gently above 60. So the more that we spend time continuing higher here, the less and less it's looking like early September, the more that it's looking like a break to new all-time highs. But I'm very focused on the fact that the new all-time high in March, we touched the overbought region. Here, if we make a new all-time high on weaker momentum, that would create the ever negative bearish momentum divergence. Usually not a great sign. Usually a sign of an exhaustion in a bullish phase. So I think this is a pivotal moment thinking about a potential higher low, weaker momentum to what happens. But again, powering higher with the RSI pushing upwards from here would be pretty encouraging. Now, there are other indicators that are actually quite encouraging right now, particularly this chart. This is these are the advanced decline lines on 4 different cap tiers, and I actually changed these colors on Friday, but did not save it apparently. So let me show you what I'm talking about. These are the 4 breadth indicators for the New York Stock Exchange, large cap, mid cap, small caps. I'm color coding them bullish green because as of Friday's close, as I wrote to my market misbehavior premium members, they all made new highs. So even though the S&P is not quite at new highs yet, these cumulative advanced decline lines have all now made a new 52-week high. And matter of fact, most of these making a new all-time high. The S&P still briefly below. Boy, it just barely didn't quite get above there, did it? It's right at that level. We'll see how things play out over the next day or two. But I'm certainly seeing these breadth conditions as fairly constructive. The fact that the New York Stock Exchange advanced decline line, which is the most widely followed, I think for good reason. The S&P not making a new highs, but the breadth conditions are making new highs. That's actually quite bullish. That suggests that the indexes are just not reflecting the underlying strength. And when in doubt, I would follow the breadth conditions because that tells you about participation. Breadth conditions are strong. That should be an encouraging sign. I mean, maybe the difference there is the fact that it's a lot of things that are outside of the Magnificent Seven that are getting it done and moving to the upside. Open question there to think about. Let's talk about gold here briefly because the GLD having a decent move, but starting to rotate just a little bit lower today, and very different than the rest of the commodity space. Here's spot gold. This doesn't have today's close on here just yet, most likely, but this is as of this is a weekly chart. I was going to say that looks like a really nice weekly chart. The weekly chart of gold here, and this is spot gold again, so it's actually using the gold future, but you can see the 2020 high, the 2022 high, the 2023 high. We briefly overshot that in October, November of last year. Finally, February into March, we break above an astoundingly long-term resistance level. It's what we call a big base breakout, and I see that it's a really constructive development from a technical perspective for gold, and you can see that we've pushed quite above there. That line is around 2070 to 2100. We got all the way to 2450 just in the last month. Now, the daily chart of gold kind of shows this breakout here. That's your breakout level around 2050 to 2100. There's the breakout and then these higher lows. There's the new high. Here's the higher low. So 2300 now your new short-term support level. Again, as the market goes higher, as an uptrend continues, I sort of think of these as steps. And so, we make a new higher low, we rotate higher, 2150 is your new stop. We've now blown way above that. We pulled back to around 2300. The 50-day moving average kind of just around that level as well. So I think this chart stays above 2300 on a pullback. And this is a really constructive development. The GLD, of course, to go to the other chart that I have to track gold prices. Similar, of course, you can see today gapping downwards a little bit, but the momentum overall has been quite strong, really coming off of the October low last year. The RSI has remained above 40 almost that entire time. And so the fact that we pull back and make a higher low with the RSI around 50 is actually a quite constructive development. Now, we may be putting in a bit of a lower high there, and that's something to watch. 220 on the GLD. Can we push back above there? That would be the open question. Thinking about some of the stocks that are on the move today to wrap up our market recap here, I would say Moderna comes to mind. The healthcare sector, not particularly strong on a relative basis, I would say, compared to others like utilities, like technology. I mean, these are sectors that have done much better. Healthcare is sort of a weird sector with a lot of different things in there. You've got biotech, pharmaceuticals, you have life sciences, medical devices, medical equipment, all of these different types of names, all related in healthcare, but quite different in some ways in terms of their business models and influences and what causes changes. But if you look at Moderna, obviously a pharmaceutical name, really drew a lot of attention during the COVID era. You can see resistance around 110 to 115. That was the peak around 115 in January. We can see we retested that in March. Again here a couple times in April again, then we finally broke above it, and now look how resistance becomes support, and that happens so often. Actually, I'll just use the little inspect tool, which is a really nice way of doing that. If we do this, we can just line up the previous high, so you can see how that high there coincides with this high from January, some of these other highs, and that lines up pretty well with that support level. So when resistance becomes support, that's a technical concept called polarity, which recognizes or implies that levels have meaning. The market has memory. And so for now, right, we've broken above that resistance, which I think is pretty encouraging. We're now finding support at that breakout level. And honestly, you could probably label Moderna an ascending triangle pattern. You might call it a head and shoulders bottom. I don't think I'd argue with you there. Maybe you call it an ascending triangle pattern, kind of coming off of those lows. But in either case, breaking above resistance around 115 is the trigger, right? That's the sign that that pattern is confirmed. And then we validate that by breaking a little bit further to the upside. So currently well above that breakout level. I think Moderna is setting up nicely and up again another 7% today. Look at Apple. Of course, Apple has been one of the least impressive of the FANG names because it was underperforming really from December of last year, really into early April. The relative strength line just continues going down. Again, we'll do a segment in a short while on relative strength, focus on some other nuances of relative strength. But this chart here, even at this point in late April, pretty ugly, right? And you saw that gap up. This was a what's called a gravestone doji candle. You might call that a shooting star candle, depending on how that candle looks in your opinion. But we basically gapped above a moving average, but closed right back to it. So sort of confirmed a failed breakout attempt. Then all of a sudden we gap higher on earnings. We chop around a little bit. Today it may look like we're rotating higher. The concern I've had for Apple is after the gap above the 200-day, we just really hadn't had any additional follow through. Today we're finally getting back above that open from the gap day. I would say that's a pretty nice setup for now. So you have clear support at the swing low at the 200-day moving average. Do we ride that higher up to 195 for a retest of previous highs from 2023 and 2024? That would make sense to me. And then a break below 180 would invalidate that thesis and suggest downside risk or elevated downside risk. Amazon's another one. Now, Amazon obviously a bit of a different look because while Apple has had really a retrenchment of sorts over the last 6 to 12 months, Amazon's really more been of a long and strong, one of the leaders in that Magnificent Seven group. But what I'm seeing on the chart of Amazon is one of the things that concerns me, right? For the S&P and the NASDAQ to not just get to previous all-time highs, but really push above there, you need to have big names making some significant gains, right? Apple, Amazon, Meta, not Netflix, Nvidia is where I was going for. Some of these huge mega cap names have incredibly large weights in the S&P. As I cited, I think recently, the top 10 members of the S&P are about the same weight as the bottom 425. That's how big those top 10 stocks dominate the weights in our benchmark. So if Amazon is flashing a clear bearish momentum divergence, what I would argue it very much is, that's not a great sign. So that divergence that I'm talking about is this right here, right? Higher highs in price from April to May, lower peaks in momentum. And again, that is something you often see at the end of a big move. Another time you saw those kind of back here, June, July, going to the August peak. You had a lot of stocks flashing those divergences around there. And what that suggested was where we're at right now is not at the beginning, it's more toward the end, right? We're in the 8th or 9th inning as opposed to the 2nd or 3rd inning. And so Amazon showing that weakening momentum, the S&P potentially making new high on weaker momentum, that's not an encouraging sign telling us there's a lot more to come. That actually suggests that this run we've had is probably nearing a bit of an endpoint. Now, the last time Amazon dropped, it gapped down to a clear support level around 165 to 170. That was from back here, that gap up after first quarter earnings. So there's your downside objective if you do get a bit of a breakdown and we fail to hold the 50-day. But overall, that's something I would be watching this week as well. Now, it's not all bad. It's not all ominous. Some charts are actually looking quite good. Apple was one of those, sort of rotating higher today. I'm seeing other names as well. And again, breadth conditions overall are improving quite a bit. The AD lines are making new highs. Most stocks in the S&P are above their 50 and 200-day moving averages. That's all encouraging. Charts like UAL that is, are apparently making a higher low and then rotating back to the upside. After popping higher here in mid-April, we can see we gapped above the 200-day and then just kept going. We stalled out here, and you may actually think of this as a big resistance area, and that's the concern I have for UAL. That's why it's not a great chart at the moment, I would say, is because you really need to propel above the March 23 high, the July 23 high. That's all sort of in this range, right above current levels. So nice short-term price action, but a lot of overhead resistance. It usually is just less of an ideal setup. American Airlines, similar kind of move today, up almost 4% today. But again, a lot of overhead resistance, in this case, a little shorter term, 1550 to 16. So names like American, like United Airlines, these are constructive short-term moves. I like the tactical breakout. It's not giving me enough of a all clear, we're going to break out to new highs signal just yet, because the momentum is not necessarily there yet. And overhead resistance usually is something you want to be wary of. Get excited about a breakout above overhead resistance, which is why I think some of those charts could be meaningful to watch here. That's it for our market recap. And again, directionally, not much movement, but underneath the hood, a lot of stocks, and the breadth indicators in particular. Keep an eye. Make sure you have a regular process of reviewing those market breadth conditions. They're overall quite constructive here. A couple quick announcements before we get to our next segment called It's All Relative. First off, we welcome your questions. We had a great mailbag show on Friday of last week. Hope to do another one here very soon. We'd love to answer one of your questions on the air. The mailbag running a little low, and we would appreciate any questions you have. What are you running into as you are trying to analyze these charts, navigate these markets using the Stockcharts platform, using the technical analysis toolkit, whatever else you're using? Email is always best. thefinalbar@stockcharts.com is our email address. And here on YouTube, just drop a comment below the video that you're watching. We'd love to hear from you and hope to answer one of your questions in our next mailbag show. I will be doing a free webcast tomorrow called Sell in May, 5 charts you need to follow. You can sign up for that free event at marketmisbehavior.com/sellinmay. We're going to talk about this normal seasonal pattern, May through October, actually the weakest half of the year compared to November through April. So we are done with the strongest part, which has been incredibly strong recently. Does that mean Sell in May is going to work pretty well here in 2024? I'll show you the evidence. We can review it together and let's decide. So sign up for that event for free at marketmisbehavior.com/sellinmay. That's Tuesday this week at 1 p.m. Eastern. Our next segment called It's All Relative. Let's focus on the message of the charts in the form of relative strength and why relative performance right now is so meaningful. Now, we have a couple different ways to think about relative performance, to be honest with you. One of the ways that I like to do that is with the relative rotation graph, the RRG. So I'm going to go here to Charts and Tools, go to RRG Charts, reminding myself we need to get my friend Julius de Kempener back on the show here and see what his take is on this rotation. Always interesting to hear what Julius is thinking about the rotational environment. He obviously created this visualization, is probably the heaviest user on the Stockcharts platform because it's his creation. But on the weekly RRG, again, I'm noting some defensive sectors looking quite strong. Utilities and consumer staples. These are the two that have rotated into the the improving quadrant here in blue and heading northeast. Some of these other early leaders, like materials, like industrials, actually starting to rotate downwards. And so I'm seeing an improvement in some of the defensive sectors. Switching this to the daily view, we can see a really unusual, I can't remember the last time I actually saw this happen, where a sector like utilities, actually rotated down. So this is what happened with utilities. We're heading northeast. This is back, where are we at here date-wise? Let's see, April 30th. We then continue forward a little bit. Here by early May, we're rotating southwest, which is the direction of deterioration. But look at how utilities just in the last couple days now hooking up a little bit. So what I would say is that utilities farthest to the right on the daily RG, heading northeast again, certainly the strongest. So we're going to talk about this performance of defensive sectors, why that's so meaningful, and look at some individual stocks that are sort of top of mind based on that analysis. Now, one of the things I like to include when I'm thinking about relative strength, the RRG is my first go-to, but I also like to look at just the pure relative strength on 3 different buckets of sectors. And again, there's no perfect, I'll tell you. I've spent many years trying to think about this with really smart people. There's no great way to group these sectors. There are a lot of very flawed but meaningful ways. And so I tend to simplify by looking at 3 groups of sectors. Number 1 would be growth sectors. We'll start here. Technology, communication services, consumer discretionary. One of the reasons why something like utilities or in some cases like consumer staples are looking so good on a relative basis is also because some of these other sectors are struggling a little bit on a relative basis. My relative analysis in this form is actually a zero-sum game because we have a group of sectors and they are weighted versus the S&P 500. So you're looking at a subset of the S&P versus the broad S&P. So if this is going down, which it is for technology, that means over the last 1, 2, 3, 4 months, the technology sector, the technology stocks within the S&P as a group are underperforming the S&P. Now, this is cap weighted, so it's mostly Microsoft and Apple in this particular ETF, but I think the argument holds. Consumer discretionary, what a rough chart. And this, I think, in a lot of ways is fueled by the struggles of Tesla, which is one of the biggest names in the numerator in the XLY. So the XLY has actually been a rough relative performer since mid-July. Now, the XLC is the outlier here. It's actually held up quite well. It's really the market because its relative strength is fairly consistently sideways. Now, the value sectors at times, particularly in February and March, it was a very value-oriented leadership group. You had industrials trending higher on a relative basis, financials starting to trend higher, materials trending higher, energy trending higher. Look how in the last couple of weeks, energy has rolled over on a relative basis. Industrials have rolled over. Materials are starting to roll over a little bit. And even in the last couple of weeks, financials coming off as well. So what is improving to fill that gap of performance? And it's defensive sectors. And that's when I think about the fact that the S&P and the NASDAQ are testing new all-time highs on the surface, that's actually quite bullish. But the fact that utilities and consumer staples look as good as they do is a little less encouraging. Real estate really hasn't been much of a factor. It's been sort of in line with the market over the last couple weeks, and consumer staples popped really nicely in mid-April, stalled out a little bit. But utilities consistently, when I rank performance, when I look at areas where I'm seeing a lot of breakouts, consistently utilities tend to come up on my scans. Let's look at a couple names within that utilities sector. And when I was scanning for stocks making new 3-month highs, which is something I do for my market misbehavior premium members, I did that last week and was looking at some of the charts that came up with. There are a bunch of utilities names in there, to be honest with you. To be honest with you, quite a few in a lot of different sectors, don't get me wrong. But when there are a ton of utilities, there's a red flag that pops up in the back of my head thinking, I'm not thrilled about upside potential when utilities do so well. And here's why. The reason why it's concerning when utilities or consumer staples do so well is because as an institutional investor, let's imagine you run a portfolio of $1 billion and your benchmark's the S&P 500. You can't use derivatives, you can't hedge, you're a plain vanilla portfolio manager, which means you have to be fully invested into stocks. So what do you do if you're concerned about growth from current levels and you're concerned about the performance of the benchmark? Well, you can't just sell things and go to cash because that's not within your mandate. You just have to own stocks. So what you do is you go to defensive sectors that have a high income component, right? So you go to low volatility, low beta, which means if the market goes down, these types of stocks will tend to do a little bit better because they'll go down less than the rest of the market, but also they have a decent dividend component. So 3 sectors kind of fit that criteria: utilities, real estate, and consumer staples. Now, there are also things like financials have a decent dividend, and some industrials for sure. Other value sectors certainly can have a healthy income component, but they're a little more sensitive to economic conditions. So utilities tend to be a little more immune. What's interesting about the chart of CEG, which is one of the top, it's in the top, 1 to 2% of large cap stocks in our scooter rankings. What's interesting about the chart of CEG is the fact that this breakout here happened, right? So we had the peak in November, we sort of retested it here, and even though the trend was positive, felt like it was sort of stabilizing. All of that now accelerating to the upside, and from mid-February to now mid-May, this stock has gone from around 130, we'll call it, from mid-February to almost a double, right? I mean, this is an 80% gain up to around 214 after touching 220 on Friday session. Southern is another, and these are in the conventional electricity bucket. This is a little less of a strong long-term performer, but certainly is breaking out of a fairly established base. And look at the relative strength, which is continuing to push to the upside. VST actually at the moment is the top-ranked stock in our large cap scooter rankings. So again, bit of a red flag when the number 1 stock out of all the names in the large cap space using our proprietary trend following model, number 1 is a utility company. I don't feel particularly strong. Now, Vistra is an incredibly strong chart. And if you covered up the ticker, you would think this was a technology name. It looks like a super microcomputer or MicroStrategy, one of those AI names when it's just accelerating to the upside. But this is a utility stock, and it's had a 200% gain year to date, right? I mean, we finished the end of last year here around 38. We're currently right around 90. So, I mean, a really impressive rally off of those peaks. You'll notice with a lot of these utility stocks, by the way, a bearish momentum divergence, again, was just telling me maybe we're a little extended here and a bit of a pullback. This particular one, VST, was down 3.5% today. But the story is really the improvement in the relative strength. And it's a great reminder for me when I see a chart like this. Don't be afraid to own something like a utility stock if the relative strength tells you it's worthy of your attention. We tend to put our blinders on and focus on sectors and stocks and names that we know. One of the benefits of technical analysis, you can go outside your comfort zone and find something like a utility name with a decent dividend yield, with decent relative strength. And as long as you do your due diligence and understand what this company does and make sure you're okay with that, recognizing strength and following those trends, I think can be super helpful. Now, it's not all about the leadership of utilities. Let's also talk about technology. So if you told me that I would be doing a relative strength segment and I'd be focusing on utilities and technology, you told me that at the beginning of the year, I'd probably laugh, but here we are doing it in mid-May of 2024. But that's what the charts are telling us. Applovin, if you're not familiar, really has built their business around helping app developers, mobile app developers, get their games out there. Which is one of the reasons why the stock has done so incredibly well. I mean, after making an incredibly weak low there in December of 2022, below $10 a share, you can see we rotated higher. We're now to almost 90 this week. But what's interesting is these breakout patterns, right? So you have this sort of stepwise motion. You see quarterly earnings. We gap higher, we pull back, we rotate higher, we gap higher, we chop around, we break out. We gap higher, we chop around, we finally break out of that base, we gap higher, and we continue this. So March, April, May, we're kind of right around that next earnings release. We can see we gapped higher here over the last week. We're currently around 86. So given what's happened previously, this stock has a tendency to gap higher on earnings, to chop around for a little bit, often have a bit of a pullback there over the next couple weeks, but then resolve to the upside. And those breakouts have often been really meaningful signals that there's more strength to be had here. So certainly worth following. And also the 50-day moving average, which we retested, the momentum overall strong. But as this segment is called, it's all relative, right? Forget about the price action for a moment and just focus on the fact that you have a stock that outperformed in the first half of 2023, really was a market performer in the second half of 2023, but from February to May of 2024 has been a clear outperformer. You want to own things, I would argue, if your goal is to outperform the S&P, you need to own things that are outperforming the S&P, as our friend Tom Boley likes to say. So a chart like that certainly fits the bill. TOST is another one. Now, this is interesting in the short term. We gapped higher last week, and after that gap day, it's really been kind of choppy sideways. So I'm not really getting that follow-through vibe as we're retesting the previous highs from February and July of last year. But for now, we appear to be in a pretty decent shape, and we're certainly not going down. That relative strength line breaking out above current levels is what would give me more and more confidence that a name like this may deserve a spot in a portfolio. Folks, that is it, and that's a wrap for the show. Thanks so much for joining us every weekday after the close. We have a lot of great content on tap for you this weekend and the coming weeks, so make sure you continue to watch. Don't forget to like and subscribe while you're here. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.